the setup has been absolutely great. So, you don't get these kind of technical setups very often to where you get a pullback from an overbought condition to a very good line of support. In this case, the 50-day moving average, which was we bounced off that, kind of three times going into the election. And then post-election, and then the day before the election, the markets were kind of sniffing out what was going to happen, started rallying. And then, of course, after the election was done, the market just simply exploded.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my good and sequential friend, Lance Roberts. Lance, how you doing?
Yeah, you're right. I'm sequentially here every single week.
You're sequentially here, and I was trying to find an adjective for the word sequel. And interestingly, there really kind of isn't. So sequential was the closest one I could come up with. But we now have Trump the sequel. So the election is over. We actually have a pretty clear election, which was the one thing I think that you and I were most hoping for here. I see you've got your electoral flags behind you, probably celebrating the fact that we don't have a contested election here.
Exactly. No, that's out. That's honestly it. The fact that we just have an election, it was done on election day, and this isn't getting drug out in court for months is just it's good for the markets. It's good for the economy. It's just good for everything. So,
Okay. Well, look, I want to get into exactly how you think it might be good for the markets and how it might be good for the economy. We can talk about some of the proposed programs that Trump has already announced he wants to do. You can talk about, obviously, how you think the markets are going to react. I know you just issued a piece on that. We also want to talk about this week's FOMC meeting and the latest Fed rate cut. I think we also should talk about the fact that I don't know if it's going to happen while we're talking, Lance, but we're pretty close to S&P 6,000. So it might hit it today. If not, maybe next week. So let's talk about that too. Real quick before we do, just a couple quick things. One, this is a very special episode of our weekly market recap because today is the 1-year anniversary of Thoughtful Money. And I appreciate the thumbs up there, Lance. Thanks. It's been a wild ride so far since we started this brand new and 100% independent brand. We've just a couple of quick stats. In the past year, so 365 days, produced 270 videos that have received over 12.5 million views. That's 4.5 million hours of view time. We have over 100,000 subscribers, and folks might remember we got the nice, pretty plaque here from YouTube celebrating that. I just want to thank everybody who's been a part of this journey because by definition, none of those stats couldn't have happened without you, our viewers, giving this channel your support and your attention. And I'm eternally grateful for that. And every day I'm working to figure out how I can better meet your desires and needs through this channel. But we've done a lot in a year. So kudos to everybody. And Lance, you've been a big part of that.
Thank you. Yeah, no, it's been great being here too.
All right. And then I do have one big ask. And as folks who are regular viewers of this channel know, I don't really make many asks. I mean, all that video material I talked about, we offer for free. So my one big ask going into this 1-year anniversary for folks is to subscribe to our Substack. That's a way in which you get kept in the loop the most on what we're doing on here in Thoughtful Money, whether that's new videos, whether it's special content that we make available to our Substack audience, whether it's events like conferences, whether it's surveys that we want you to participate in, whether it's live chatting with me. There's all sorts of things that happen on the Substack that builds on top of the YouTube experience here. Also, I just want to say, if you feel motivated to, upgrade to the premium version of Substack, you basically get, a much greater enhancement of this experience. One of the big things you get are my write-ups of every single interview that we do here. I take the notes so that you don't have to. We also have our Macro Pass service where you get premium research reports from all the experts that appear on this channel. There's a bunch of other benefits I won't go into because you hear me mention them on the channel here from time to time. But not only do you get those benefits, but you help keep this channel in business. And that's why here at the 1-year anniversary, I'm just saying, if you like it, kind of consider this the pledge drive. Like, go sign up at least for free to the Substack. But if you can, please upgrade if you're not already a premium subscriber to premium. And one reason to do that sooner rather than later is we launched at a ridiculously low price last year. We had one price increase. Now that we've got a year's worth of operating this channel, we have a good sense of the cost structure and whatnot. The Substack price, monthly price, is going to go up a bit at the end of this year. But if you're already an existing subscriber, don't worry, you're going to get grandfathered in at whatever price you initially bought. So those of you folks that are only paying $8 a month, you'll be paying that forever as long as you stay subscribed. So if you sign up before the end of the year, you'll get in at the current price of $15 a month. And when it rises to $19 a month at the end of the year, you won't get that price rise. You'll just stay in at 15. All right. Anyways, thanks so much, folks. That's the last of the pledge drive. So let's get to the meat. All right. Donald Trump is now going to be the 47th president of the United States. We already have a pretty decent sense of a lot of the big tent poles of his platform, Lance. I know that you just wrote a piece today about how you think markets might react to him. So if we can, let's prepare to walk through that. Sure. Before we get to the specific market reaction, let me just ask you a greater question. So we know that Trump wants to continue to extend the tax cuts that were set to expire at the end of this year. He's obviously talked an awful lot about tariffs. He's talked about mass deportations of up to somewhere 10, 15, 20 million people that are here legally. And he obviously wants to make some pretty sweeping regulatory changes. Now, there's a lot of other stuff on his platform as well. Some of it is pretty, pretty change agent-y-ish, right? Like, hey, I'm going to break stuff. We have bad models. We want to create new ones. So my big overarching question for you is, can we have that type of change, that type of major surgery without experiencing initial, pain to the economy?
No. And, this, I was talking about this last week, is that, part of his agenda is to bring Elon Musk in as the government efficiency office. It's actually the Department of Government Efficiency, DOGE. So, but,
great play on words, great reference to Elon's
great marketing,
penchant for Dogecoin. Yep.
Yeah, fantastic marketing. But I mean, look, he's talking about, slashing a lot of government employment, those type of things. And if you take a look at our last employment reports, almost, for instance, just the last month, if it hadn't been for government employment, we would have had a negative employment print. So that's, so that is going to obviously impact the economy. If you cut spending, for instance, Robert Kennedy Jr. is talking about slashing entire departments of the FDA. Needs to be done, mind you. But he's talking about massive changes and gutting agencies and returning a lot of the government agencies, which should not be in the government to start with, like education, infrastructure, energy, healthcare, education. Those shouldn't be part of the national government. Those should be part of the state. So they want to return a lot of that stuff to the states. That's going to break stuff, right? That's going to reduce a lot of government employment. So the key here for the administration is to be very clear about what you're going to do and explain why this is a good thing, because Americans will accept the impact from it as long as they understand why you're doing it. If you just come and start slashing stuff without explanation, you have to remember most Americans are just trying to put food on the table and raise their kids. That's it. And that's, that was a big issue with the actual voter turnout that we saw across across the country. It was just the average middle class American just voting for something different than what they had. And that's exactly what you should expect.
Yeah, so sorry to interrupt.
Hold on, let me finish. Let me finish.
Oh, sorry. Okay.
It's what's very important is that they don't really understand the dynamics of how government works. And so they've got to be very clear. Look, we're going to do these things. I would plan on having and experiencing some pain in the economy, but long term, this will be good. It will reduce the deficit. It'll reduce the debt, the things that you're concerned about. It will increase economic transparency. It will increase government transparency to you. As long as you explain these things up front, I think you're going to get a much bigger pass from the voting public in general, because they understand why you're doing it. But communication is going to be really key before you start breaking stuff, because it is going to cause an economic downturn. If they do it dramatically all at once, you're going to have a 2-3% decline in economic growth.
Okay, and that's exactly what I wanted to put on the table here, right? And I agree, and we said this for months leading up to the election, that what was likely to drive the voting was it's the economy, stupid, right? When people are feeling pinched, that's at the forefront of their mind when they walk into the voting booth. So you vote for change, right? Okay, whatever the guy in charge is doing isn't working for me, so I'll vote for the other guy, right?
Right.
Now, Trump has talked about these big changes, but they've so far been packaged in, we're going to have this beautiful economy, when I'm in charge, right? So to your point, I don't think the communication has happened yet, at least, of, wait a minute, yes, it's going to be a big, beautiful economy at the end of the day, but we got to go through the hard work and take the bitter medicine to get there, right? So it sounds like you think a key critical next strategic step of the administration is to start messaging, hey, we got to tear down before we build up, and that's going to be a process that's probably not going to feel good, but hold out hope for this vision I have in the long run.
Well, absolutely, and for instance, it's always interesting. During government shutdowns back in like 2011, and multiple times we've had government shutdowns over the years, we temporarily furlough 950,000 non-essential workers to the government, right? And so they're off, they're not working, and the government functions fine. So, this is one of the areas that, Elon Musk is potentially target, is that we do have a lot of government employees that really don't do a whole lot, and they're not necessary. That's why, the big concern for a lot of people is that he'll do the same thing that he did at Twitter, which is walk in the first day, fire half the company, and then basically sort out the balance. And something like that done without communication and done that quickly would be devastating economically. And look, when I say devastating, I'm not talking about a depression, right? So don't freak out over this. But I mean, you're talking about an immediate type of recessionary impact to the economic data. And that would certainly impact the markets. It would certainly not make voters feel very well. It would certainly get them more fearful about their job security, particularly if they are related in some way to the government. In other words, I have a business that relies on government contracts. There's a lot of flow through that would happen from that type of action. So, coming in and just willy-nilly doing stuff without careful planning and doing it in a more moderated process. Again, all these things are great. They're great ideas. They would make government a lot better. But if you just do it willy-nilly without some type of moderate process of working through it over 2 or 3 years, you're going to cause a lot of economic upheaval.
And I don't know at this point in time. I mean, I'm sure they're looking at a bit of what Milei has done in Argentina, and that there is, hey, to get stuff done, you just got to get out the chainsaw and start cutting, right? So
she's been running around with a chainsaw.
Yeah, exactly. I mean, literally, that's been his brand. And Vivek Ramaswamy, who's been an advisor to Trump, his big thing was, let's dramatically cut the size of government. And I think I remember him talking during his campaign, was like, yeah, I think we just start with basically saying, look, if your social security number ends in an odd number, you lost your job, right? In that way, we'll just get rid of 50% of the people right away. And then we'll figure out, did we lose some people we should hire back? Did we keep some we need to let go? But again, starting from the point of cut first and then analyze, right? So
yeah, that was Musk's approach with Twitter, and he probably overcut, right? But then you just hire back the people you need. But again, there's more to government than a private company, and in terms of government, it's so far-reaching across the economy, but more so than Twitter impacts the people that work at Twitter, right? But there's with government, it's the layers of government and all the people that are dependent on government in some shape or form or fashion for their job. I'm just saying that it's okay to do this, but I think it has to be done in a very thoughtful approach. I'm not saying it shouldn't be done. I'm just saying it should be thoughtful.
Right. I think we agree it should. Will it? A big question. One of the question marks out there that we need to think about from a market forecasting type of thing. All right, and then I think of things like immigration. So we've talked a fair amount recently on the legal and illegal immigration situation, and Trump, since he's been elected, has come out and said, yeah, that wasn't just stump speech. I'm going to do this. There are millions and millions of people that came here, were let through the border, declared amnesty and said, okay, look, you're now in the court system. It might take us 5 to 10 plus years to get you your court date and figure out, whether you're allowed to stay or not. But in the interim, you can stay, and here's work authorization. So there are millions and millions of undocumented workers that are working in the economy here. And if we start sending them back, and put aside for a moment whether you think that's good or bad, what impact is that going to have on the economy?
Yeah, it's going to impact the economy. I mean, they do. If they're here illegally, they still work within the economy. Right now, they may get paid off the books. They may get paid in cash. They may not, pay taxes directly, but they pay taxes indirectly. When they buy stuff, they're paying sales tax. When they buy gas, they're paying a gas tax. When they buy, when they purchase anything, they're paying some form of tax. So they do contribute to the tax revenue of the economy for both the state as well as the government.
Right. They also they increase corporate profits because they're generally a cheaper worker too. Yep.
Correct. And that was actually noted by Jerome Powell. So just because, if you disagree with Adam's comment, it is true. Even Jerome Powell at the Federal Reserve said one of the side impacts of immigration, both legal and illegal, is that it reduces the cost of wages because they'll work cheaper and they work harder than what Americans will. So yeah, if you go through a mass, you start just rounding people up and sending them out, that's another issue that's going to impact the economy short term. Now, whether you agree with it or not is irrelevant. It's just that's what's going to happen when you do this. Now, does it wind up solving some of the other issues that we have in the country? Maybe, maybe not. We'll find out. There's a lot of debate on both sides of deportation and what that would mean. But again, we've deported individuals before. This isn't the first time. Obama deported, don't quote me on the number, of like 400,000 individuals during his administration. The economy didn't collapse. So, this isn't a new thing, right? That we're deporting people. It's just basically going back and cleaning up kind of our immigration issue and getting it back to where it should be. And again, immigration reform is going to be a very important part of this, to reform immigration itself, to allow for people to immigrate legally into the country. And that's really kind of the big clause about this, is that people are really worried about deportation. Well, if you're here illegally, you can leave and come back legally. There's nothing stopping you from doing that. Just cross the border, then come back through the legal process. If you stay here illegally and then you get caught, you're going to get deported, and that's going to be an impact on you and your family and, those type of things. But that's what's coming. And yes, it's going to have an impact. What the long reaching impact of that is yet unknown, but, it is going to be an impact to the economy.
Okay. And then the last thing, then after this, we'll get to your specific article, Lance, is tariffs. Now, as I understand it, having heard Trump talk about it, he doesn't necessarily want to impose tariffs. He thinks of using the tariffs as a big stick, right? And the example I've heard him use a lot is like, all right, a foreign conglomerate wants to put a auto manufacturing plant in, say, Mexico or something like that and sell into the US. And Trump would say, okay, great, you certainly can do that, but I'm going to put 100% tariff on your cars. And good luck selling them here because they're going to be ridiculously expensive, right? Mm-hmm. But if instead you choose to put your manufacturing plant in the US, I'll give you all sorts of tax breaks, right? So he's trying to use it as the big stick to get the behavior that he wants. Now, he will probably have to use it use tariffs at times to show that he's serious, right? And obviously that will have some impact on the economy in the short term, right? I mean, if you finally force these countries to start building manufacturing plants and employing more Americans and all that stuff, that's great. But that takes a couple of years to really come to full fruition. In the interim, people are paying higher prices until the tariffs are removed and stuff like that. So again, is this another shoe that you expect to drop on the economy? No,
on tariffs, no. Here, let me share with you a chart real quick, because I'm actually writing an article on this very issue right now.
Shocked I am to hear that.
Shocked and amazed, I am quite sure. But here, let me share this one chart with you. And this is just something I'm working on right now. Okay, so this is the red line is the 10-year Treasury yield. The black line is CPI inflation, and the green shaded background is GDP. What you see here is that interest rates and inflation pretty flat for the most part, but economic growth was pretty strong. The time period for this is November the 1st, 2016 through January the 20th of 2021. That is Trump's first term.
Okay, so COVID is almost not a part of this chart.
Sorry?
COVID is almost not a part of this chart.
It's well, like it is. I mean, it's that big green bar that drops down on GDP. That was COVID, right?
Oh, okay. So the 2020 has shifted over. All right, you're right then. So it's got what, about how much of COVID is in there?
All of it, because remember, his last day in office was January 2021. The election was November of 2020. Biden took office in 2021. So that little the years are in the middle of the. If I drew vertical lines for the years, the lines would be in the middle of the numbers.
Would be in the middle. Okay, sorry. So the last year of the chart is a year of COVID. Okay.
Yeah, exactly. So you see the year of COVID, you see that big decline in 2020, and then you see it rocket up, as all that stimulus hit. And then the only reason you see part of the January 2020 bar is because that was the first quarter where Biden took over.
Got it.
But the point here is that there's been lots of concern about, oh my gosh, tariffs is going to increase prices. That's going to cause all this inflation in the economy. Interest rates are going to go soaring because of that. And yes, during his first term, we had very good nominal GDP growth, but no inflation, no interest rate rise. And that's because consumers react to the tariffs. First of all, as you said, specifically, the threat of tariffs is really what it is. The enactment of tariffs are a very different thing. And again, he'll say, look, this is the stick and here's the carrot. So work with me. And then consumers also make a decision about, well, if a product coming in from China is now twice as much as it was, I'll source it from somewhere else, or I'll
buy domestic or some other. Yeah, got it.
Yeah,
right.
Exactly. So that's why you don't get, tariffs don't lead to inflation. And fortunately, we have an ability to look back now and say, look, these were all the similar during his first term, right? He tightened up the border. We had very low immigration during his first term. We had tariffs. So all the things he's talking about doing, kind of reiterating his first term, we now have evidence. We can look back and say, well, how did it work last time? So we've got evidence that a lot of these theses by economists that, have a particular bias are wrong. That these things don't lead to massive inflation. It doesn't lead to surging interest rates. It doesn't lead to a collapse in economic growth unless you have COVID. then you're going to get And again, that's the thing is that his first term was marred by that whole COVID break. If it hadn't been for COVID, it would have been a very interesting outcome. We probably would have seen slower growth into his fourth year, but we wouldn't have seen, because nominal GDP growth was declining. If you look at 2017, right after the Tax Cut and Jobs Act was passed, we had a big surge in the markets. We had, we had very enthusiastic businesses doing capex investment, bringing back manufacturing jobs to America. But again, that was another one of his priorities then. So we saw this big surge in nominal GDP growth. But after all that got cycled in 2017, early 2018, then it's like, okay, it's here, and we've done all we're going to do. So the economy starts to slow down a bit. So likely we would have seen closer to 2% growth in his fourth year as president had there not been COVID.
Okay. All right. But yeah, no, a compelling chart, right? Wield the threat of tariffs. You don't really see a big spike of inflation. At least that's what our recent data set tells us.
Yeah.
All right. Well, look, let's now get to the big question then, which is, okay, most of the policy we just went through, you said, yeah, that's probably going to have it's going to be an economic cost you have to pay in the short term for the longer term benefits. When you look at the markets and say, okay, now Trump's, in the Oval Office, what do you expect? And let's preface this by saying, I haven't actually read your piece yet, Lance. I saw you just put it up this morning. But I do remember you saying repeatedly, our market doesn't really care who the president is. And I know you were painting with a broad brush when you said that, but anyways, what do you expect looking forward in the markets from a Trump presidency?
No, so again, it kind of goes back to, policy does matter to some degree, but markets don't, as I said earlier, markets historically don't really care who's president. I mean, if you look back throughout history, markets perform well under every president, whether it's, unless you have some type of financial crisis, some type of, economic event, economic upheaval like the financial crisis, or you have a .com issue. or depression like you had back in 1929, where you had a big, massive dust bowl in the middle of the country that, we lost, thousands of heads of cattle. The government was slaughtering cattle that they couldn't, kind of do anything with. And you just had all kinds of other problems. Economically, banks were failing. There wasn't no FDIC insurance. So, but see, none of those, environments exist today that we had back then. So again, every time is different. And I'm not saying that we won't have some type of financial upheaval at some point in the future. And kind of my motto is, I think we got about 6 years to make all the money we can make, because we'll get to the next secular bear market sometime after 2030. But, until then, we got to make hay while the sun's shining, right? As the old saying goes. But again, there's policy changes on the horizon that are going to be playing kind of tug of war. The good news is that that Trump's election pretty much ensures that the Tax Cut and Jobs Act is going to get extended. Whether or not now, there's a thing about that, right? Is that we're not getting new tax cuts. It's just the tax cuts that are already here are going to get extended, permanent. Yep. So they'll become a permanent tax cut. So that's not really a driver for more profitability or anything else, because there's nothing new there, right? That's already all factored into corporate profits, corporate earnings, those type of things. Now, if he's able to somehow cut corporate taxes from, say, 21% to 15%, now that's a different story. That's going to help increase profit margins because they're paying a lower tax rate. Remember, corporations don't pay taxes. They collect taxes. And so, cutting the corporate tax rate, yes, that will boost their earnings. It just means they collect less tax. And what I mean by that is, and people, what do you mean by that? Well, corporations don't pay tax. They pass taxes on to consumers. So it goes in the form of higher prices. You raise taxes on me, I raise the cost of my goods and services, I pass that tax rate on to you. So that's why if you look back historically, profit margins remain fairly somewhat range bound over time. And in fact, I've got a chart on this.
And while you're pulling it up, let me just restate what you said. Corporations pay taxes, but it's their customers that fund them. That's what you're saying.
That's right. That's like I said, they collect taxes, right? They don't pay them. This is real profit margins as a percent of GDP. So the one thing that we need to be paying attention to is that real profit margins as a percent of GDP are very elevated. This is to due to lower tax rates over the last several years. It's also due to the function of just massive, corporate and massive government funding of the Inflation Reduction Act and all this stuff. It's also a function of inflation, because inflation gets passed on to consumers as well. So not surprising.
Lance, can you expand that chart?
Better?
Thank you. Yes, our boomer viewers will appreciate that.
No, being a boomer, I certainly understand. But but corporate profit margins are extremely elevated. But if you notice, corporate profit margins stay pretty much within a range, give or take over time, whether it's high tax rates, low tax rates, et cetera. And that's because corporations adapt, they pass on, taxes and other inflationary costs, et cetera, onto the consumer. The big definers of whether or not these corporate profit margins are rising or falling is recessions. So, during a recession, obviously corporate profit margins fall because now all of a sudden nobody's buying anything. And so I have to really slash prices and cut my margins in order to move product and services. But, again, this, if we go back historically and look, this is just the deviation of real profit margins from their long-term mean, and they are elevated. So again, we're going to see a reversion in profit margins at some point. That will coincide with the next recession whenever it comes. But, as we start talking about, policy and these type of things from the government, we look at the Tax Cut and Jobs Act, that's already factored into this. So it will require new tax cuts on top of that, which may or may not get passed, right? That's going to be the big question.
Yeah. And speaking of that point, it's worth just reminding people, because I don't know if I've seen the final data on the House, but last I've seen, it still looks like it's going to go Republican.
Yeah.
So
as of this morning, it was 211. You need 218 for control. And that's an important point, by the way. It looks like that when this is all said and done, Trump will have the presidency. Senate will be controlled by 3 votes for control of the Senate, including Vice President Pence's tiebreaker vote, and that the Republicans will control the House. So they'll have 218, 219 probably at the end of the day. The one thing you've got to remember, though, is that just because they have control of the House and the Senate and the presidency doesn't mean that they're just going to be willy-nilly able to pass every single thing that they want to pass. You still have the Freedom Caucus, which is anti-opposed to, or I should say anti-opposed. It's a double negative.
They're just opposed.
Yeah, they're just opposed. They're very opposed. That's what I was trying to say. They're very opposed to increasing debts and deficits and that type of thing. So if Trump comes in with a big spending bill that he wants to do, we're going to cut taxes and do a massive chunk of spending, then it's likely that may not pass, right? Because all you have to do is lose a couple of guys in the Senate that are kind of against, big spend, and you lose some of the Freedom Caucus guys, that bill doesn't pass. So it's not a shoe-in that just because they control all 3 branches of government, or all, kind of Congress and the presidency, 2 branches of government, that they're just going to be able to do anything they want. It's not just a blank check. There's going to be some give and take in this along the way.
Okay, and that's just what I wanted to remind people of, because understandably, most people think, oh, swept Congress, that means Trump can do whatever he wants. Not quite.
Yeah.
Okay, so in terms of what you expect the market reaction to be here.
Yeah, well, right now it's roses for the market, because they're seeing tax cut extensions. That's very good for businesses. And what you're going to see right now, in particular, is that the National Federation of Independent Business has been a very depressed indicator for a while, and that surveys small business owners around the country. And they make up about 50% of the economy. And that's been in recession territory now for a very long time. For like the last 3-4 years, it's been in recessionary territory. In fact, it's still near some of its lows. I would expect to see that index rocket higher in the next report, because those business owners tend to lean conservative, because things like good, deregulation, which is something that Trump is talking about, tax, extending the tax cuts, that's going to be very beneficial for business owners. So whenever you start talking about lower taxes, less regulations, those type of things, that's why they tend to lean more conservative than not. You should expect to see that index really gain a lot of traction. And that's also why you see small cap stocks rallying really hard over the last couple of days, because deregulation, lower interest rates, those type of things, that's all going to be very beneficial for small to mid cap companies. It's also going to be beneficial, again, to the stock market, at least in the short term. That's what they're looking at, and they're wanting to get positioned, in the markets for the end of the year.
Okay, so that's stocks. In your article, you also talked about bonds. So if we can cover any thoughts you have on bonds in just a second, I just we're going to talk more about this in a bit. But in Jerome Powell's press conference, there were a lot of people kind of pushing him to say, well, the consumer's not doing so well. Obviously, the election seems to be a reflection of that people are unhappy about the direction of the economy. And Powell said, well, he said, I don't talk to too many CEOs, but we've got the Beige Book, and the people who report to me talk to all those people. And they're saying everybody, who's running business says it's pretty good, right? He's like, and Powell might be talking his book. His job is to project confidence. But he kind of went out of his way to say, look, when I talk to the guys in the trenches, the guys that are actually regionally running, businesses, they say things are good. They're more optimistic now than they were a year ago. So, I guess you got to take that at face value for right now.
Well, you do. And business, look, economic growth is kicking along at 3%. It's not terrible. It's not great, but 3% is better than 2%, which is what we had for the last decade. So, the economy is doing fine right now. If you really kind of, you can't really look at that last employment report, as we talked about last week.
Right.
So much of that was affected by hurricanes
and strikes.
Yeah. So, just you kind of set that one offside, but let's see what the next one looks like. And there may be a trend there. We'll see. But, but again, when we come back and look at business owners, and I talk to a lot of our clientele are business owners, or they work for big companies, and they're very busy right now. There's not. They were very concerned going into the election about the state of their business, but I think now that the election is over and the outcome is what it is, I think we're going to see business owners, and this is why I said keep a watch on the National Federation of Independent Business. You're going to see that index surge higher because this just pulled a huge amount of stress off of small business owners, which are very important to the overall economy.
Right. All right. Well, so I guess we would expect to see confidence in the NFIB surveys go up. We might see a resumption in hiring, right? I mean, hiring's been trending down, but that would be a sign that, okay, business owners are feeling more confident. And then I guess we should see in continuing claims and initial claims, those numbers should start coming down. I don't know.
I can't really go much lower.
Pardon me? Well, they have been rising-ish from their lows, right?
Yeah, they've gone up a little bit, but I mean, they really can't go much. You're always going to have turnover in the economy, right?
No,
so,
obviously, yeah.
Yeah, and so there's always that. I don't know if you can actually get much lower on claims. Maybe you can. We'll see. And we're probably not going to see a massive surge in hiring. I would not expect to see in the course of the next 5-6 employment reports, all of a sudden we start hiring 1 million people a month. That's not going to happen either. The economy is pretty fully staffed. There's not a lot of excess. There's not a lot of excess employment that occurred. We've kind of worked through a lot of that. So I wouldn't expect to see a big boom in hiring, but at the same time, I wouldn't expect to see, a bunch of layoffs right now. And we haven't seen a bunch of layoffs. We've seen those kind of be moderate more than anything else. We've seen kind of rolling layoffs over the last couple of years.
It's been a rolling thunder, yeah.
Yeah. And it's just kind of been rolling. I think a lot of that may just be the case going forward, unless, but again, that's all predicated on, the Trump administration not coming in and breaking something in the process of trying to fix something. And that's a very easy thing to do if, again, slashing coming in and slashing 1 million government jobs in 1 month, that would certainly impact the economy. It would impact the markets. I don't think the markets are expecting that, but I think that's something we've got to be careful of and be aware of.
Okay. And we're going to, one question I want to ask you in a bit, but not just yet is, I'm sure there are viewers who are like, okay, so I'm hearing that there's optimism now, and we've certainly been growing at 2.5% to 3%, and that seems to be still the projection from here. And now people are maybe getting more optimistic. So that is the story of a good economy, expect status quo for the foreseeable future, versus the public anger that just got Trump elected as to how people are feeling bad about their own personal conditions. And I've got some stats that I'll bring up near the end about how we're still seeing signs that the median consumer continues to struggle. So how do you kind of balance those two things? But before we get there, I don't want to get off the bond part of your market outlook. And again, I'm sure you're continuing to get the emails I am about, bond yields are still going up, right?
Well, they're not actually. Bonds, we saw a lot of, pressure on bonds going into the election. That was a lot of de-risking, by portfolio managers. Also remember, it's also important to remember that, you have to remember that. So let me back this up real quick. Bond auctions. So the U.S. government wants to issue some debt, right? So we're going to issue $10 billion worth of treasuries. And if you don't know how this works, this is very important to your thesis on rates. So when the government goes to sell bonds, they just don't open it up to the market and say, okay, we're selling bonds. Everybody wants to show up. Y'all come buy bonds. So they're for auction, right? Now, it doesn't work that way. There's 20 primary dealers. These are all your major banks, Deutsche Bank, UBS, Bank of America, JP Morgan, Goldman.
JP Morgan.
Yeah. So those are primary dealers. So they know when the auctions are coming up. They go, oh, there's an auction coming up. Now, remember, what's my job at working at, I used to work for a bank, but what's your job when you're working for a bank? Your job is to make money for the bank. Right. That's your job. So if I know an auction for 10-year treasuries or 20-year treasuries or 30-year treasuries is coming up, which they just happened recently, then what I can do is I can go in and I can start shorting bonds to drive down the price of bonds. So if all the primary dealers are all shorting bonds at the same time, it drives down the price, drives up the yield, and so everybody starts paying. Like, I'm seeing it's inflation coming back. No, there's an auction coming, and they're driving down the price of the bonds so they can buy those bonds cheaper when they get to auction. And then they reverse their trade. So they cover their shorts. They've made money on the short side. Now they're long the treasuries because now they own them. Now they're going to go sell those bonds off to their customers and prices rise. That's why over the last couple of days, you saw a very big sharp drop off in yields going into the election. As soon as the election was over, that turned and bond prices have been rallying over the last couple of days. So you've got to set aside these short-term, volatility moves in the market. If you're owning bonds long-term, you have to set aside all this short-term nonsense. It's nonsense. If you're trading bonds, it's all about technicals. And so you just pay attention to your technicals and you're fine. So if you're and again, I technically trade bonds in my personal account. I'm long bonds right now going into the end of the year. I'm also long S&P 500 calls going into the end of the year. So, I'm betting on, a decline in yields and a rise in the S&P 500 going into the year end. Just that's all technical. You've got stock buybacks, performance chasing, yields were extremely oversold, so you're gonna get a reversal in yield. So it all works out fine. Now, long term, if you're buying to hold bonds because you want income in your portfolio, that's all about economic growth. That's nothing but wages, economic growth, and inflation. That's all that is. And those are coming down.
Okay. Two quick things. One, I know you're long bonds in your client portfolio, but you have been buying bonds personally, you just said, as well as those S&P calls. I'm assuming those are more on the personal balance sheet than they are on the client balance sheet.
That's all personal. Yeah, well, yeah. I don't do that for client accounts.
Yeah. So just want to make sure what Lance just said there, not personal financial advice, and he's trying to differentiate what he's doing personally versus what he's doing professionally, because he has to wear two different hats. Obviously can assume more risk.
I don't mind if I lose money, my own money. I just don't want to lose client money.
Right. Okay. And then the last part on bonds, again, I didn't read your piece. I just saw you talked on bonds in the piece. Is there anything in the piece that you want to talk about before we move on?
Oh, well, no, just, basically just kind of going back and just remember that, regardless of what policies are passed in government, the one thing that you haven't resolved is the impact of debts and deficits. And those are going to drive inflation, interest rates lower. You have an increasing right now share of money and interest payments of total federal revenue. More and more of it's being eaten up by interest payments. That's not going to be allowed to last for very long. Higher interest rates impact, obviously, government debt. So the one thing that you have to also remember is while there's a lot of threats about inflation and interest rates going higher, don't forget that the Federal Reserve right now is still doing QT. They're not buying bonds, they're selling bonds. They've reduced about 45% of all the bonds they bought post-pandemic. Yeah. So at some point when interest payments or if interest rates themselves become an economic risk, or more importantly, not even an economic risk, if they become a financial risk to the banks, remember, they serve the banks. So if JP Morgan and Bank of America and Wells Fargo and these guys are saying, hey, man, our collateral value is getting creamed by these interest rates, trust me, they'll reverse QT, they'll stop QT, they'll start QE, and they'll drive rates lower to bail out those collateral values. So don't think for a moment that the Fed does not have monetary policy tools to lower interest rates in the long end. But the biggest driver is government debt. While debt to GDP is declining, it's still very elevated right now. It is going to decline further as the economy continues to grow, but there is absolutely no evidence that rising interest rates and inflation can happen in an environment where you have rising debt, because it drags on the ability to convert productive investment into real activity. And you can just see this is the long-term total debt as a percentage of GDP versus GDP going back to 1790. And once you've started these processes of rising of debt to GDP, you cannot generate economic growth. So this is why we still have this demand for socialism in so many different areas of the economy, because you can't create economic growth, which is what drives inflation and interest rates in that environment. So at the end of the day, regardless of what Trump does, he'll be able to manufacture some sort of economic activity, but it's not going to lead to higher interest rates and inflation because of the debt. Now, the one thing about the markets, and this is the last chart, is that the one thing you can't ignore about markets is that they are extremely overbought. Now, it doesn't mean they can't go higher in the short term, because they certainly can, but we are very overbought on a monthly basis. Relative strength index is at where previous peaks of markets have been. The deviation from the 4-year moving average is extremely elevated, and that 4-year moving average has been the base of support. And we're at the top of this. There's been a very defined trend channel since 2009. We're trading at the top of that right now. We're 3 standard deviations above the short-term monthly moving average, the 1-year moving average as well. So at some point, you're going to get a reversal of the markets back towards its long-term move, back towards these longer-term means. So there's still even and again, this is something in maybe a year or two, or maybe third year of its term, you do something that breaks the economy by any stretch of the imagination, or you spook the markets in terms of moving too quickly, and what those impacts might be. You're going to get a reversal in stocks. But again, this something's not going to happen today. But we were talking about this very same thing back in 2019. We wrote several articles about this is nuts. This is why we're taking profits in late 2019 and early 2020. In fact, January, February 2020, which is when we were kind of rallying up in front of all this. We said, hey, this is getting really extended. We're going to get a reversal, and you got that reversal. And in late 2022 or late 2021, we were saying the same thing. It's like, hey, we're trading well above long-term means. We're going to get a reversal. And 2022 happened. So, almost like clockwork, you can count that at some point markets are going to reverse. And that's just a normal mean reversion. It'll be because of slower economic growth, or slower earnings growth, or whatever it is. But you're going to get a reversal in markets at some point. Not today, not 2 months. Maybe not even next year, but as investors, we do have to be aware of that risk, because markets are very overbought here.
Okay, and this is a monthly chart,
So it's a monthly chart, so that's why it moves very slow. The only thing that changes once a month. So so again, this market can, and again, we moved above that long-term trend for about 8 months in 2021. But remember, we also had $5 trillion worth of stimulus behind the market at that point. Relative strength stayed really overbought for almost a year. In that process, we're about 3 months into this overbought condition, so it can stay overbought for quite some time, but eventually you'll get a reversion.
Okay, and kind of where I'm going with this is, looking at the channel chart there of the S&P, we are right up near the upper limit there. We haven't crossed it yet like we did in 2021, but to your point, we were still riding all those trillions in stimulus, which maybe made that high an exceptionally high height. So my question is, if we look up at the RSI, do you sort of consider, now that we're in that green territory above the top line, is that sort of like the fuse has been lit? We don't know when the bomb is going to go off at some point.
No, don't scare people.
I'm just asking legitimately. Should they worry or no?
Yeah, that doesn't mean the fuse has been lit. Because again, it can stay that way for a year or two, right? Back over here, you went almost 2 years overbought, and the market just kept rising. So this whole time, you're like, oh my gosh, I know this market's going to crash any moment. I don't want to be in the markets, and you lost 2 years of gains. So but again, no, this is a yellow flashing light. It's just something. It's like, hey, I'm aware of this. I'm paying attention to it. Today, it doesn't impact my portfolio. I want to be invested. In fact, we just took our dividend equity model to full equity allocation yesterday. So, I want to be invested right now through the end of this year. Then, next year, whatever it is, if we start to see weakness creep into the market, it won't happen overnight. But if we begin to see weakness creep into the market, it'll be like, okay, that warning sign is now becoming more of a flashing red light. So now we need to start taking money off the table.
Okay, and that's kind of where I was going is what are the conditions in which you would get to say, take money off the table? Because you're right, it can hang out in that green area for months, quarters to years. And I think I heard you say, it doesn't mean it's going to resolve in a crash. It could trade sideways for a super long time or whatever, right? Yeah.
Well, I mean, think about 2022 is a good example. We went from the peak of that channel to the bottom of that channel over the course of a year. It took a full year to do it. Markets were down 19%. It was kind of a bouncy decline the whole year. Wasn't terrible. You could still make money in that market. And we resolved it. And then coming out of October 2022, the market took off again, right? And we've been rallying ever since. So, these things can either resolve themselves in a very sharp decline like we saw in March of 2020, or it can be just a prolonged period of just sideways choppy trading that, kind of bleeds off that condition and allows the bottom of the trend channel to catch up with the upper end.
Okay. All right. Well, look, let's move on now to the Fed, right? So just yesterday we had the release of the FOMC guidance. As I mentioned earlier, they reduced the benchmark rate by 25 basis points. So we're now at 450, I believe. I mean, it was a pretty dull, announcement and press conference. Powell was particularly tight-lipped, especially when asked anything related to Trump. Just giving one-word answers, no. And when they wanted more information, not going to talk about it.
Yep.
But basically, they're keeping QT in place. They're not changing the pace of QT. So basically, all they did was deliver the much anticipated quarter point cut. Looks like market is expecting another rate cut in December. I just checked the CME tool. It looks like there's like a 60-something% chance of another 25 basis point cut then. And Powell basically said, look, everything's going pretty well. Economy looks good. We feel good about where everything is. We're not worried. A lot of digging from the journalists, as I mentioned, trying to see if they could get him to comment on the general population's worry, that type of stuff. He didn't want to take the bait. I don't know. Did you take anything else material from this?
No, I mean, we, obviously in our daily market commentary, which we post every day on Substack, is, we touched on this today to a degree and just basically talked about the fact that really when you dig into this, there's not a tremendous amount of change. There was some more, and as always the case. So back up real quick. The Federal Reserve has like this predefined template for speeches and other press releases. And then what they do is every month they just change a word here or there and then just adjust it. And so like the big thing is that they took out a couple of words. It said, for instance, previously it said inflation made further progress towards the committee's 2% objective, but remains somewhat elevated. This time it said inflation has made progress. It just took out further. Right. And so what does that mean? Everybody's trying to read into that. Oh my gosh, does that mean it's not coming down as fast as they thought? Or maybe it does, maybe it doesn't, who knows? But the big thing is that he believes that, and I'm going to read some notes here that we put in our daily market commentary today. He believes, so this I'm going to read from it. He believes that the recent rate increase has less to do with inflation and more with increased expected economic growth under Donald Trump. So he's expecting more economic growth under Trump. We remain on a path, this is a quote, we remain on a path to a more neutral stance. Powell believes that the Fed will continue to reduce rates, but the pace and terminal rate will be data dependent. Now that is really key here, the terminal rate. Is the terminal rate 2%? Is it 1.5%? Is it 3%? That's the big question. And that's where the terminal rate is where inflation, economic growth, and wages are all going to stabilize. And if they stabilize at 3%, then the Fed's pretty much going to be done at a 3% Fed funds rate because those all should align with each other. Right now, you have a 4.5% Fed funds rate, and you've got inflation running at 3%. So Fed funds is too tight. Monetary policy is too tight relative to where the economy is right now. But at some point, that's going to stabilize, and all those are going to converge and meet. Now, if the economy slows down more, or there's some type of financial issue, et cetera, he's going to have to cut rates more dramatically. Powell said the statement about inflation highlighted in the first paragraph is meant to show that the Fed remains flexible to bringing down the inflation to target. Again, it appears Powell doesn't really want the market to think the Fed is on a predictable course, but trying to get rates back to neutral. And lastly is that we don't comment on fiscal policy, but Powell said that the Fed thinks a lot about how fiscal policy and deficits affect the economy and inflation. And they're not overly concerned about the recent rise in interest rates, because again, that was really more of just positioning for the election, and the focus is for rates is kind of that more persistent change to financial conditions, which should equate to lower bond yields in the future.
Okay, and again, you've said now in several different answers to several different questions, you are continuing to expect lower bond yields in the future, and actually Powell was was asked several times, hey, you worried? You guys did this big 50 basis point cut, and now the 10-year is 80 basis points higher. And Powell basically said, well, we're watching it closely, but it's not something we're worried about. He obviously didn't use the word transitory, because I'm sure he knows that would have blown back in his face. But he did say, like, we're not factoring it into our models right now, which I think is a pretty definitive point of view from a guy like Powell. If he cared about it, he'd be having his staff put it in their models. So as long as he's telling the truth on that, then fine.
But I just think you have to go back to, our work. You have to go back to Lacey Hunt's work, which is that there's just a tremendous amount of economic data that suggests that interest rates can't go higher from here, and that the long-term trajectory of long-term rates is lower, not higher, because of the debts, the deficits, productivity, demographics. All that is going to drive rates lower versus higher.
Okay. So let me just ask this question then, Lance, which is, let's say somebody's watching and they have not got into the bond trade at all yet. In terms of the opportunity that the market is presenting right now, given your outlook for bonds, how good of an opportunity is this to get into bonds right now?
Well, so it depends on why you own bonds, or want to buy bonds. Why are you buying them? And then what's your time frame for it? So if technically you're just trading bonds, the trade point for buying bonds was the day before the election. You had a massive blow off, 3 standard deviations oversold. So technically it was a great entry point to buy bonds. Now you've already reversed a big chunk of that. Bonds are about halfway back to overbought. So I think we could probably get to 92, 93, 94 on TLT for a trade over the next month or two. We'll see what happens. But again, remember why we own bonds, right? We don't own bonds because we're not making some, it's not our bet. Our analysis is why the way we structure our duration. The reason we own long duration bonds in our bond portfolio is because our long-term outlook for yields is lower because of economics, inflation, and GDP, wage growth, those type of things. So the reason we have more duration in our portfolio, so long duration bonds make up about 10% of our portfolio, right? The rest is all short to intermediate duration. But the reason we own bonds is because we have to. So if we're running a 60-40 allocation, we have to own 40% bonds. So it just depends on how we own them, right? We could own corporates, we own treasuries, that's our choice. Our dividend equity model has no bonds in it whatsoever. So I don't own bonds in that portfolio. So why do you own bonds? I own bonds because, as we laid out here before on the show, is that if I'm trying to build a 6% rate of return, bonds can deliver roughly about a third of that 6% right now. I just buy 4% yielding treasuries, and I've already got 2% of my portfolio locked up on a 50-50 basis. So I own bonds because I want to lower volatility. I want to create steady income. I want capital preservation. That's why if I want to own bonds, that's why I buy them. All the other stuff is nonsense. So if you're worried about interest rates going up, don't buy bonds. If you're worried about inflation going up, don't buy bonds. Right? That's but if you're wanting capital preservation, if you're wanting lower volatility in your portfolio to reduce risk of equity ownership, and you want something that's going to hedge you if the market completely falls apart, then own treasuries, and you're going to pick up the 4% yield on bonds. So again, it just depends on what are you adding that asset class to your portfolio for? And most people's theses for their asset classes are entirely wrong. Why do you own gold, right? I own it because it's going up. Okay, but how does it fit within your asset class? How does it fit in your asset model? Oh, it's going up, so I own it. And I have all my money in it. That's great. What happens when it's going up? And again, you talk about the market. I just showed you that monthly chart on the S&P. There's only been 3 other times in history where gold has been this overbought on a monthly basis, and the outcomes from that was not good. So, if you're, you've got to have, why, everything you own, you need to understand what your dynamics are, what your duration is, and the underlying premise of why you own it and what it's supposed to be doing for your money.
Okay. So the person who is looking to own it for the reasons that you hold it in your portfolio, right, where this is a long-term asset class and it's mostly, I want to get that dependable income going forward, right? So, long bonds are now the 10-year and above, duration-wise, or above 4%. Not as good as we had at certain times, not as good as we had a week ago or 2 weeks ago, but still potentially pretty good if you think that the next 5+ years are going to be declining bond yields and slowing economic growth.
Well, not only that, if I want to generate, if I have 50% of my portfolio in bonds and I want to generate a 2% return, I buy 4% yielding treasuries. I really don't care what prices do over the next 10 years. I own a 10-year treasury yielding 4%. So I'm going to get 4% every single year on my money. That's what I own it for. And it reduces the volatility in my portfolio. So again, don't worry about what rates are doing because prices are going to move up and down.
Right.
The benefit of owning treasuries in a declining interest rate environment is that I also get capital appreciation. So now my 4% return becomes an 8% return over that period of time because of capital appreciation. As yields go from 4 to 2, which in theory they should to align with economic growth, then I'm going to get capital appreciation. My total return on bonds will be much higher than just the dividend income, or just the interest income. But when you buy a bond, you look at, see, this is the great thing about bonds, and nobody talks about bonds very much. But the great thing about bonds versus stocks or gold or anything else. So let's say you go out today, Adam, and you buy a bar of gold, right? And so you put your money into gold. I'm going to go buy a 10-year treasury. So you come to me today and you say, I just bought gold today, and in the next 10 years, I'm going to make this much money on gold. I go, well, how did you calculate that? Right? And so all your thesis on your appreciation is all assumptions.
Right.
I bought a bond. I can tell you to 1/100th of a cent exactly what my return will be in 10 years.
Right, because it's a contract.
It's a mathematical calculation. So everything we invest in outside of bonds, and this is why all major all wealthy people have a big chunk of their money in bonds. This is the reason when you look at high net worth investors that you look at their allocation, they have about 20% in stocks, and they have a big chunk of their allocation, usually 30 to 40% of their money is in bonds because it's a low risk, guaranteed rate of return of their money. And remember, what wealthy people want more than anything else is a return of their capital, not a return on their capital.
Right. They don't want to lose what they have. Yeah.
Exactly. So again, and again, look, we manage a lot of models for our clients, and we have clients that come in with all different risk profiles. So I own bonds in portfolios because they are part of the model. So I have a 60-40, we have an 80-20, we've got a 20-80, we've got a 70-30, 30-70, we have an all-weather model, which it's got a whole lot of different assets in it, but it owns some bonds, it owns gold, it owns a bunch of other stuff. We also own models that have absolutely no bonds in them whatsoever. So we manage all these models because everybody's risk profile, their tolerance is different. And, so again, when you're building your own portfolio model, it's fine to own all these different assets. You just want to understand, why do I own an asset? I own equities because I want capital appreciation and I want dividends. I own bonds because I want capital preservation and I want income. I own commodities or gold because those are bets on, whatever your thesis is behind those bets, but those are purely speculative and very volatile. So I want to minimize those bets within my portfolio to minimize the overall volatility of my portfolio itself. So, as you build out that allocation model, always focus back on the volatility issue, because again, the thing that gets us as investors is the volatility. When all of a sudden you wake up one morning and your portfolio is down 5% or 4% or whatever it is, you're immediately panicking and you're making bad investment decisions because you had way too much exposure to a certain asset class in your portfolio. So you wake up and your portfolio is down 3. It's like, oh my gosh, I gotta get out of this. Everything's crashing. And then that may not be the case at all. It's just that you had too much volatility in your portfolio. So just, again, think about, how you manage your money, and then think about the house that you're building that's going to hold that money, because that's got to survive the storms and everything that kind of come along the way.
All right. I really appreciate you going into depth on that, Lance. And again, you're exemplifying why I have you on this program week after week, is to help people see through the mind of an experienced professional financial advisor, and how they think about building wealth over time, right? It's not just chasing headlines or reacting to, each new piece of new real-time data that's going out there. It's putting a strategy together and then executing that, taking into account what's going on and making sure that that's not changing any of your primary theses. All right. Well, anyways, Lance, before we get to your trades, which I'm sure folks are your latest trades, which I'm sure folks are curious about, if we can, let's just pull up the S&P chart, and if you can give us a general sense of where we are. While you and I have been talking here today, the S&P has been doing its absolute best to try to hit the 6,000 mark. Doesn't look like it's quite hit it yet, but we've been within just a couple of points of it. So who knows? The day's still young. What are the technicals telling us at this point?
Well, I mean, everything's just fine. Actually, the setup has been absolutely great. So, you don't get these kind of technical setups very often to where you get a pullback from an overbought condition to a very good line of support. In this case, the 50-day moving average, which was we bounced off that, kind of 3 times going into the election. And then post-election, and then the day before the election, the markets were kind of sniffing out what was going to happen, started rallying. And then, of course, after the election was done, the market just simply exploded. And, our target is based on this rising trend line. We had this rising wedge pattern that we broke, and that took us down to that support level. So you had this really nice oversold condition. Markets were sitting on support. You got, some good news, from the election that really spurred the kind of the algorithms to kick into play. And now we're at our 6,000 target is based on the assumption of this trend line being kind of drug out here a bit. It just got there a whole lot faster now. Unlike Wall Street, we don't continually raise our targets. We set a target early in the year and we stick with it, right, wrong, or indifferent, but that's how we judge our performance. So at the end of the year, if the markets are at 6,500, we were clearly wrong on our target of 6,000, but we thought 6,000 was based on fundamentals, forward valuations, those type of things. We thought 6,000 was a reasonable target by year. We may very well exceed that now, but it's not going to be straight up from here, mind you. So we've got a few things coming up that the markets will have to deal with. First of all, we're going to have retail sales numbers coming out pretty soon after Thanksgiving. So Black Friday, which started I think 3 months ago. We'll have that number coming out and just how much shoppers are kind of spending. We may see some weakness in the consumption that could potentially weigh on markets a bit. First two and a half weeks of December, there's a big chunk of mutual funds that have to make their annual distributions for the year. So they have to distribute their capital gains, their interest, their dividends, those type of things. Excuse me. So we typically see a bit of a sell-off in the market in the first couple of weeks of December, and then that's what sets up that Santa Claus rally into the end of the year and the first 5 days of January, because that's where managers are getting repositioned. They're doing window dressing for the end of the year, and then come the first of the year, they're getting all their trades on because they have a whole year to generate gains without having to worry about taxes until the next year. So that's why you typically get the Santa Claus rally last 5 days and the first 5 days of January. So we could see a pullback here sometime over the next, 3-4 weeks or so. I would certainly use that as an opportunity to get capital allocated. We added exposure yesterday as well to all of our models. We've added some small and mid cap. Small and mid cap stocks have now broken out of their previous all-time highs. So we're seeing a lot of nice momentum in that area. And again, with the election of Trump, that should be pro-business friendly for small and mid caps. And as we showed in today's daily market commentary, there's, as I said before, there's a very high correlation between the NFIB annual rate of change in that index and small cap stocks. And you can see that this big surge right now in small cap stocks is going to be followed probably by a very big surge in NFIB confidence. So this is probably going to continue for a while longer as this occurs. And again, as I said, we just kind of really broke out of these previous tops here. So a nice breakout. We overbought here short term. So we've added a very small position of IWM to our portfolio, and we're looking for pullbacks to add to that position. So, right now it's all working, and then in the dividend equity model, we were at 75% exposure. We started that model at the beginning of the year. We've got it, and we've been slowly kind of building into that portfolio, and it was about 75% exposed going into the election. But now with the election behind us and the Fed rate cut, we've now got that one fully allocated going into the end of the year.
Okay, so in general, it sounds like a big green light. As you said, you could maybe see some reason for why there might be some weakness in the next couple of weeks, but any material pullback you would see as a sign to get in at better prices and ride this thing into the start of
Yeah.
2025.
And again, yeah, because going for the next 2 months, you've got $6 billion a day in buybacks. You've got performance chasing by retail and professional investors that need to play catch up. There was a lot of de-risking going into the election because of the uncertainty of the outcome. So all that's got to get regrossed up. And then you've got just momentum in the market, which is going to kind of drag kind of everything higher with it. So, that's kind of what we're seeing over the last couple of days.
Okay. Let me ask you this, because I saw somebody ask this yesterday. Bull markets climb a wall of worry. It seems like we've moved from worry to, I don't know if euphoria is too big of a word, but a lot of optimism, we'll put it that way. Does that worry you at all, that we're beginning to, remove the worry that the bull market uses to climb?
Well, yeah, and when markets get back to really overbought conditions, we'll take money back off the table.
Yeah. Okay. All right.
So,
well, look, go ahead.
There's nothing stagnant here. That's, this is, there's always a reason to worry, and the markets are going to worry, next month about the employment report or something. They'll find something to worry about, right? But there is a lot of optimism right now because the policy structure coming in is very pro markets. That's very good for financials, technology, energy stocks, healthcare stocks. It's all being set up pretty well here. And that's why, like, for instance, you're seeing today in the markets, you're seeing kind of a big pickup. Eli Lilly, which we added to yesterday, is having a big day. It's up 4%. We're seeing UNH rally. So there's some optimism around healthcare. Consumer stocks are doing well here. The Mag 7 had a huge day yesterday, so they're giving up a little bit of that gain today, not surprising. And also don't forget that NVIDIA is swapping out for Intel in the Dow. So the Dow is now going to have NVIDIA and its basket as well.
Got it. All right. All right. Well, so this obviously leads to you taking action at your firm. You said that you have basically brought your equity models up to 100%. And it sounds like you've bought some specific stocks along the way.
Yeah, so the goal is, I just don't want to confuse anybody, right? So our 60-40 model is at 60% exposure. We're probably going to take that closer to 70 over the next couple of weeks. So we'll overweight equity going into the end of the year, most likely, not guaranteed, but that's kind of the plan right now. And the dividend equity model, we took it to 100% exposure, but it's supposed to be 100% stocks.
Right.
And all of the dividend equity model is to be 100% stocks. It's supposed to track the S&P, but give you a higher yield. So it can't track the S&P if it's not 100% exposed to stocks.
Yep.
Yeah.
Yep. Okay. So you made those changes, and then specifically, what have you bought, sold in terms of individual positions?
So yeah, we in the ETF model and in the equity model, we bought IWM. So we just added broad exposure to the Russell 2000. We did sell our position. We've been trimming Stanley Black & Decker, but they are having some troubles, and so we finally just closed out that position. Had a nice gain on it, but we sold out that position, closed it out, swapped it for IWM right now. Added the Eli Lilly in the equity model, and then in the dividend model, it's too long of a list of changes, but basically we just pretty much bought everything up to target weight in the dividend equity model. So if you go to simplevisor.com, you can view each of the models and look at all the positions and weightings accordingly there.
Okay, great. So busy week for you, obviously. All right, great. Well, look, before we start the wrap up, actually, I have a rant that hopefully should be quick, but I'm actually excited to get your thoughts on it. But before we get there, let me just return to that question I mentioned earlier, which is, okay, so there seems to be a lot of confidence out there right now about the economy. You showed a bunch of charts. We talked about Powell's level of optimism and confidence. And that does seem to have a marked contrast with what the average voter seemed to be expressing at the voting booth, right? And I just wanted to share these quick headlines. So there's a chart I'll see if I can pull up in a minute, but back to our talking about the pig through the python. Very clear at this point that consumers have burned through all their excess savings from the pandemic, and they're now at a savings deficit. I think it was well, I'll get the chart. We'll take a look at it. I want to say like 281 billion is the collective like savings deficit that chart is showing. But two headlines. One is Molson Coors said U.S. beer demand sinks in, quote, challenged macroeconomic environment. And then this morning, Hershey cuts full year sales outlook as Americans dial back on snack consumption. Maybe that's somewhat tied to the, the fat loss drugs. Thank you. That's the chart I was looking at. But basically, it seems that the consumer's at the point where they're struggling so much that they're drinking less and eating less snacks, and those tend to be sort of like like the old-fashioned movie theater thing. Like in a depression, those do well because that's all people can do, right? Is go to the movies and eat and drown their sorrows, right? Sounds like they can't even afford to do that anymore, right? So how do you square the circle right now, and when you look at the economic situation?
Look, the economy is going to slow down. It's going to slow back towards 1.5% to 2% growth. That's the long-term trend line. We're going to get back to that level. Consumer, all that boom that we saw from all the excess money that we put into the system, that has run out, has run its course. Consumers only have so much to spend. Wage growth is keeping up with inflation, give or take a little bit right now, but it's not enough excess to create above average economic growth. So these 3% prints that we're putting in terms of GDP growth, that's going to slow towards 2%. And that's why, as I was saying before, is that if you take a look at inflation, wages, and economic growth, they're all moving towards 2%. And the less money you have to spend, you can't have inflation, because inflation is a supply-demand equation. It's simply a function of, the reason we had inflation is because we gave people to spend money and we had no supply. We shut down the economy. Now you've got plenty of supply, but people have no money. So now, in order to get products or services sold, I have to start reducing my prices to move product and services, which brings inflation down. So far, it's been a challenge. Corporations have been able to maintain higher prices. People are trying to figure out ways to buy stuff, but now they're starting to clip back on things that they were buying before and looking for alternatives.
Okay. All right. So basically, you consider expecting slower economic growth ahead probably the more likely, and I know you've said this many times, but okay, to you, the data points I'm mentioning are validation of that projection.
Exactly.
Okay. Well, look.
And I was just to say, and just remember, Trump may come in and do a lot of policy changes, but policy takes time. If you do an infrastructure bill, let's say Trump comes in, he's going to do another infrastructure bill. Well, it takes 8 months to get a bill written and passed. It takes another 6 months to, try to get, kind of the operation set up for it. It takes a year to start planning for projects. So, it takes a long time for policy to translate into economic activity. It doesn't happen just overnight. So, one thing we're going to have to, kind of get our head around is that, Trump policies may all work fine, but it may not be to the latter part of his administration or the next administration.
I would say probably even more likely the next. Yeah, is where you see the brunt of them. Yeah.
Yeah, I mean, the same thing with Reaganomics. Reagan did a great job with Reaganomics. Clinton was the beneficiary of it. It just takes time for it to work its way through the system.
Through the system. Yeah, agreed. All right, Lance. Well, look, we'll have to end it there, but yeah, getting very interesting here, right? Obviously, totally new playbook in town with the new president. The Fed continuing its rate cut programs here. The markets, in Goldilocks for sure, and that's what Darius Dale, was very clear about with his models as he presented at the fall conference here for Thoughtful Money. So, it looks like blue skies ahead for the foreseeable future. So, hopefully that's.
Don't say that. I mean, look, it's very right now. Well, no, I don't want to mislead people and say, because what will happen is that this market's going to correct next week. And they're going to say, well, Adam and Lance said it's blue skies from here, and I went and put all my money in the market. No, markets are getting back to overbought here. We've had a very big run over the last 3 or 4 days. Expect this market to pull back here a bit going into the election, but use dips, if you get a sell-off that lasts 1 or 2 days, use that as an opportunity to put a little bit of money to work. It doesn't mean go whole hog crazy and throw everything in the markets. I don't want to mislead people and have them think it's just, there's no downside risk, because there is certainly still risk. but, already we have China, Ukraine, Israel, they're all starting to talk about peace and ending kind of all these conflicts that are going on. That's certainly going to be very beneficial for the markets if those things, continue to go to fruition. So again, there's certainly some upside, but there's certainly some risk going into the end of the year as well. So don't ignore the risks.
Okay. All right. And with that, folks, so we'll start wrapping up here. If you think the even more important thing that happened this week, above and beyond the presidential election, was Lance coming on this program this week, let him know your appreciation for him and for his American flag by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you want some help in navigating this market, maybe taking advantage of some of these opportunities while keeping your eye out for the risks, highly recommend you do so under the guidance of a good professional financial advisor. If you'd like some help with that, consider scheduling a free consultation with one of the ones endorsed by Thoughtful Money, perhaps even Lance and his team there at RIA. To schedule a consultation with them, just go to thoughtfulmoney.com, fill out the short form there. All right, and don't forget, folks, if you can, please support this channel by signing up for our free Substack. To do that, just go to thoughtfulmoney.com/newsletter. And if you want to help fund this channel's continuing into the next year and hopefully many years thereafter, consider upgrading to the premium service and getting all the benefits that come along with that. Lance, my friend, as usual, I will give you the last word here.
Yep. No, it's all good. So just have a great week, and we'll see you back here next Friday.
All right, everybody else, thanks so much for watching.